Hey everybody, I get a lot of questions about adjusting entries. In fact, I think the adjusting entries portion of financial accounting classes is usually like the hardest portion for most students. They usually kind of introduce it to you right up front, right after you figured out debits and credits a little bit, and then you have to jump into these strange adjusting entries. So I just wanted to put together a quick video to explain them, and there'll actually be a separate video that has a walkthrough of a number of adjusting entry problems, just so you can see them. Anyway, so adjusting entries are simply entries that we make at the end of an accounting period to recognize revenues and expenses that we haven't necessarily gotten the money for yet, or revenues expenses that we paid for in the past, but that we need to charge to the current period. So that's pretty confusing. But recognize that there's times when we pay for an expense in advance. Maybe we are paying for our insurance for the next several months, but we don't want to record all of that expense right now because that insurance coverage is going to be for several months. So instead, what we do when we pay for insurance in advance is we record that to an asset account called prepaid insurance. And then each month, as we use up some of that prepaid insurance, we do an adjusting entry to show that we had an insurance expense and that we used up some of that prepaid insurance. Other times, we may have received money in advance for work we haven't done yet. Sometimes people will pay you in advance, and then if you record it all as revenue when you receive it, that could be misleading, especially if they're paying you for multiple months worth of work. So instead, what we do when someone pays us in advance, we show our cash going up and we show a liability account called unearned revenue. And then each month, as we earn some of that revenue, we're going to record it as revenue and reduce the liability. So the nature of adjusting entries is sometimes we have expenses that we pay before we incur. Sometimes we have expenses that we incur before we pay. Sometimes we have revenues that we earn before we receive any money, and other times we receive money before we've earned it. And so we have to do an entry at the end of the month to show how much of those revenues we've earned during that month and how much of those expenses we've incurred during that month or during that financial period, so that our books will be accurate and our financial statements will be accurate. Still a little confusing, so let's take a look uh, at a couple more things here. So this is why we do them. I kind of mentioned that already, but we want our statements, our income statement, our balance sheet, and our statement of retained earnings or stockholders' equity to accurately reflect our financial position. We want to match our revenues and our expenses to the correct time period. We want to provide reliable data so that the decision makers, the people using this information, can make good decisions with it. And we want to make sure we're following accounting standards and applicable tax laws. So typically, we break down our adjusting entries into four categories. Actually, two broad categories, accruals and deferrals. And then within each of those two broad categories, we have uh, accrued revenues and accrued expenses and deferred expenses and deferred or unearned revenues. Still confusing, right? Because you're like, you're just using words. I don't know, Mike. So let me try to help a little bit more. Accruals is where we earn the revenue before we receive money, or an accrued expense is where we earn or incur the expense, is the right word actually, before we get any money. So the examples we have on here for accrued revenue is where we've earned interest by having our money deposited at the bank, but we haven't had that interest deposited in our account yet. That will usually occur when they do the statement in the first few days of the next month. So at the end of the month, we need to show that we actually earned that interest, and we do an accrued revenue adjusting entry for that. An accrued expense is where an expense is incurred but not yet paid or recorded. The most common is wages payable. Maybe I get to the end of the month. My employees have worked several days on this most recent paycheck, but I won't pay them until the next paycheck. Maybe I pay them every other Friday or something. So I have to do an adjusting entry to show that I've incurred that expense, but I won't actually be paying it until the future. But I need that expense on this month's or this financial period's income statement so that it's accurate. Deferrals is where we get the money before we earn it, or we pay the money before we incur the expense. So the most common type of deferred expenses are when we pay an expense in advance. Okay. I mentioned the prepaid insurance, very common for people to pay for a whole year's worth of insurance. But if we were to record that entire insurance payment as an expense in the month when we pay it, that's not going to adhere to the matching principle very well. We're going to show this big expense in the month we pay it and then no expense for insurance over the next several months, when in fact that prepayment is getting us insurance coverage every month for the next several months. Depreciation works the same way. When we purchase a building or a big piece of equipment, if we were to show the entire cost of the building as an expense right now, we'd have this huge expense up front, but then no expense in the future, even though that building or piece of equipment is going to benefit us for years to come. So we use depreciation to spread out that expense over the life of that asset that we're purchasing. And so each month at the end of the month or each financial period at the end of the period, we do an adjusting entry to show how much of that cost of the building are we claiming as an expense. And then finally, with unearned revenues, that's where we received money before we earned it. So this happens when people pay us in advance. This happens a lot for things like law firms, things like that. Accounting firms, and like I had a storage business and people would do that. They would pay me in advance for the storage, maybe for a whole year's worth. But if I recorded that all as revenue when I got it, I would show all of this huge revenue right now and then none in the future. When in fact, what they were doing was paying me for a whole year's worth. So I would record 1 month's worth each month of that revenue. Okay, so that's the explanation. It can be a little bit confusing, so I'm going to show you some examples. So at the top of each of these examples, I have this remember. Okay, this is what we're doing. Adjusting entries are journal entries made at the end of an accounting period to update the balances of revenues, expenses, assets, and liabilities to reflect their true values. Okay, so here's our accrued revenue. Here's the example. A law firm provides legal services to a client in December for $3,000, but the client will not be billed until January. So we've earned the money in December, but we're not going to actually get the money until the future. We need for our revenue to be correct on our income statement and our accounts receivable to be correct on our balance sheet at the end of the year. So we do an adjusting entry to recognize we've earned the revenue. Remember, a credit or a revenue is increased with a credit, and that our accounts receivable, which is an asset, is going up. So the adjusting entry recognizes we've earned the revenue, even though we have not yet been paid for it. That's an accrued revenue adjusting entry. Next, we have an accrued expense. Those are expenses that have been incurred but not yet paid for. So it says a company owes $2,000 in interest on a loan for the month of December, but the payment is not due until January. So again, what we want to do is recognize on our December financial statements that expense. So we'll debit the interest expense account and we'll credit the interest payable, meaning interest that we owe in the future. Recognize in both of these transactions, there was either an expense or a revenue, and then there was either a receivable or a payable. You'll never see cash in an adjusting entry, and you'll always see either an expense or a revenue. Why? Because the whole intent of an adjusting entry is to update the balance of our revenue expense accounts and our assets and liabilities to reflect their true values. Okay, so that's a pattern. If you're ever doing one of these and you get cash or you think it's cash, remember that's wrong. You can, I don't know, flip yourself in the mouth with a ruler or something and say, no, that's wrong. No cash in adjusting entries. Or if you have an adjusting entry that does not have a revenue or an expense, you can slap yourself on the hand and say, no, that's wrong. There's always a revenue or an expense in adjusting entry. I don't want you to actually hit yourself. Okay. I just do something that helps you remember that. Deferred revenue adjusting entries, where our revenue is received in advance, but we haven't earned it. And maybe that's not even worded right. We'll say we received payment in advance, but we haven't yet earned it as revenue. So here's our example. A company receives $10,000 in advance for 12 months software subscription from a customer in January. By March 31st, 3 months of the subscription service has been provided. So these are a little bit confusing because you have to say, okay, what's happening here? If I got $10,000 for 12 months, I would take $10,000 and divide that by 12 to figure out how much a monthly amount is, which is $833.33. And then the problem tells me that by March 31st, we've earned 3 months. So I'm going to type times three, and we can see that we've now earned $2,500 worth of that revenue. So we're going to debit the unearned revenue account, which is a liability because we no longer owe this to our customer. And we're going to credit service revenue because we've now earned service revenue. So you have to think back when we got paid this money, we would have debited our cash because our cash would have gone up, and then we would have credited our unearned revenue liability account. Then, as we earn the money, we'll debit the unearned revenue to bring that liability down and credit the service revenue to show we've earned the money. All right. So the last kind are our deferred expenses. And I've actually done two examples of this because you'll see a couple different kinds. But here's where we have spent the money in the past, but not yet incurred the expense. So here's an example. The company paid $24,000 for a 1 year insurance policy on January 1st. By March 31st, 3 months worth of insurance coverage has been used. So again, what we have to do is say, okay, back when we would have paid for that, we would have debited our prepaid insurance, an asset, to show that we had paid in advance $24,000 worth of insurance, and we would have credited our cash because we would have been paying out cash. Then, when we get to the end of the quarter, in this case, we want to do an adjusting entry to show 3 months worth of that expense being incurred. So I take 24,000, I divide that by 12 months in a year, $2,000 a month, and I'm going to take the expense for 3 months. So we end up with $6,000. So we'll debit our insurance expense, 6,000, credit our prepaid insurance, 6,000. And a similar type of deferred expense is depreciation. So that's where we are allocating the cost of an asset, a long-term asset like equipment, over its useful life. So our example, a company purchases a delivery truck for $30,000. The truck is expected to last 5 years with no salvage value. Each year, $6,000 or the cost, 30,000 divided by the number of years in the truck's life, will be depreciated. And depreciation just means allocating its cost as an expense. So at the end of each year, we'll do a depreciation expense debit for 6,000, and then we'll credit the accumulated depreciation account, which is a special asset account that we link together with our in this case, our truck asset to show the amount that we've depreciated. All right, so there is just a little bit about adjusting entries. I know that this is not going to make you an expert, but I hope it explains it a little more clearly. Remember always that an adjusting entry is made at the end of an accounting period, and the intent is to update the balances of revenues and expenses, assets and liabilities to reflect their true values. Remember that you'll never see cash in an adjusting entry, and also that you'll always see either an expense or a revenue in an adjusting entry, paired with the appropriate asset or liability account that goes with it. I hope that's helpful. If you have questions, put them down in the comments, and I will do my best to answer. And like I said, I'll put out another video that does a walkthrough of some examples of these problems that you might see. Have a great day, and good luck on this part of the class.